Hey, this is Justin with DayTradeTheMarkets.com, and thanks for joining me for this presentation called 7 Steps to a Perfect Trade. We're going to talk about how to consistently identify, execute, and manage high quality, high probability, high edge day trades. Let's get a bit of an overview before we get going. And the first thing I want to mention is that I use this phrase perfect trade in the presentation, and I'm going to explain exactly what I mean by that toward the end. But I just want to make clear that it's not meant to be hypey. Unfortunately, in this industry, it seems like about 80% of the stuff that I look at is just crap. There is a lot of good stuff, but a lot of it's crap, and it can tend to be hypey and deceitful. We really try to go out of our way to be the opposite of that, and I hope that will come through in this presentation. But to be sure, I just want to point out that's not meant to be hypey perfect. There will be losing trades. You will have to deal with these sort of things, and that's just the way trading is. But what this presentation really is, it's going to talk about a process for making solid trading decisions. And this is a process that I use. This is a process that we teach our members, and we have found both personally and with myself, it really turned my trading career around. And we have found that to be the case with very just a great number of people that we've worked with. And I will say that this is not the holy grail or anything like that, but if you do commit to this process, it does work extremely well. So before we get going on the 7 steps, I do want to talk about that word process that I mentioned. There is no magical secret to successful trading, and I know that so many of us, especially early in our trading careers, are often looking for that, that secret, if you will. There is no secret, but if there is one common denominator among successful traders, whether you study them, whether you are one, whether you know them, whatever the case may be, I can almost guarantee you that successful traders are process focused rather than being results focused. So in other words, they're trying to focus on how to do the right things to make the right decisions, knowing that the money will take care of itself. A couple of ways that you can tell if you tend to be results focused, and I know we can all kind of fall in and out of these traps, but it's something to really be aware of. Is if just a few examples, if you sweat every tick, if you're just living and dying with every move up and down that the market makes, or if you're begging the market to go in your direction once it goes against you, or conversely, if you get euphoric or greedy when things are going your way. Another example might be if you know exactly how much you need to get back, if you're down for the day early, you know exactly how much you need to get to back to break even, or how much you need to hit your daily goal, or whatever the case may be. One of the big things with me here is that that I've certainly battled it in the past, not to an extent I still battle it, is that if I take a loser, or if I just missed out on taking a big winner, a lot of times I'll tend to want to force trades and try to get that money back, even if it's just an opportunity that I missed. So again, I just wanted to bring this out because it's so important. These are a few of the indicators or telltale signs that you are in a results-focused or a money-focused state of mind as opposed to a process-focused state of mind, and that's something to be very aware of. Because the opposite of results focused is process focused. And what that means is that you're simply focused on making the best possible decision that you can at any given moment based on the knowledge and the information you have. And we talk about this a lot, but what we think really your job description is, if you want to be a successful trader, is a professional decision maker. Okay? Because if you can focus on your process and focus on making good decisions time after time consistently, that is what's going to lead to good profits. And I realize this is a bit counterintuitive because in essence we all got into this business to make money. We're interested in making money, but if you're focused on making money, if you're focused on results, you're going to lose money, I can guarantee you. If you're focused, on the other hand, on making the best possible decision, those profits are going to take care of themselves. Okay, I wanted to throw that into this presentation because it's just so important, and it's something we believe in so strongly that you really have to be focused on your process, on your decision making. That's where profits come from. Okay, so the next question obviously then is, what is the 7-step process for identifying and executing and then managing high quality day trades? I'm going to talk about that in a second, but I want to mention that this is just a brief overview of the process. You can probably already tell that I can go on, but I could literally talk about these steps for hours at a time, and we have a lot of other information on our site and in our training material and in our live sessions and that sort of thing. But I just wanted to give you a brief overview of this process to see if it's something that might resonate with you and make sense with you. So, again, there's a lot more, and we're more than happy to answer any questions you may have if you just want to send us an email or whatever the case may be. So step 1 And please don't discount or overlook this step. It's so easy to do. But step one, it's so important, is to be aware of your mental state. Okay? You don't have to always have a perfect mental state, but you need to be aware of your mental state, so you're trading from a place of conscious decision making as opposed to unconscious emotional activity. So a few signs or indicators are, if you're anxious, or if you're sweating every tick. Are you worried about losing? Are you perhaps angry that you missed a great opportunity? Are you feeling greedy? There's a million different emotions you might be feeling. Or perhaps on the flip side, are you feeling calm and detached and confident? The fact is that you have to be aware of your mental state. And I've learned over time with myself that I love the software that we use. I wouldn't trade without it. But by far and away, the most important indicator or tool that I have is my state of mind. I know that when I'm in the right state of mind, I pretty much make money. I know that when I'm not in a good state of mind and I'm chasing the market or I get frantic, that's when I have my bad days. I mean, it's almost 100%. So I have learned over time that is my number one indicator. And if I'm in the wrong state of mind, I've put together plans, and we talk about this as well. I put together plans to fix my mental state of mind, or to step away from the computer, because I know if I'm not in the right state of mind, I'm going to lose money. So that's before anything even dealing with the market. Your state of mind is so important. That's step one of the process. Again, please don't discount that. Please don't overlook it. That's something we focus on a lot because it's just that important. Step two and 3 go together, but I want to talk about step 2 first, and then I'm going to show you how we go about doing this. But step 2 is avoid mistakes. In other words, you want to identify which side of the market, long or short, you do not want to be on. Okay? You want to identify, I know that sounds maybe counterintuitive, but if you can avoid making dumb trades, if you can avoid making bad trades, that alone will do more for your P&L than anything else you can do. So that is our first step. Avoid mistakes. Avoid taking dumb trades. And I put a picture of Jack Nicklaus and Tiger Woods on there, two of the greatest golfers. And this applies to any sport: football, baseball, soccer, any sport that you want to consider. Typically, the greatest champions are those that can avoid mistakes. It's not about being the absolute best. And if you listen to Nicklaus or Woods talk, they say they won more major championships by simply avoiding mistakes and letting the other people make mistakes, and they would rise to the top. And that's the same thing in trading, in any performance activity. Avoiding mistakes is really the first key. That's what leads to winning. Okay? So step 3 is very similar. Just like on step 2, we wanted to determine which side we did not want to be on. Step 3 is to determine which side, long or short, that you do want to be on. And I realize it might seem like it's just the opposite, but sometimes, and the reason we separate this is because sometimes you can determine that you do not want to be long or you do not want to be short, but that doesn't automatically make the opposite true. Sometimes the best thing you can do is nothing and sit on your hands and wait for the other things to develop. So you don't want to be short, in other words, but you're not so sure you want to be long, so you're just going to sit pat. It's that idea. So that's why step 2 and 3 are there together. And now I want to talk about, obviously, the most important part is how can you determine that, how can you make that determination? How can you decide which side you don't want to be on, which side you do want to be on? And we have a lot of different techniques that we use to determine this, but probably the foundation or the most important thing that we look at is a tool we call relative aggression bars. It's kind of the foundation of what we do. And these bars are telling you in real time, and this is a very unique proprietary type of an indicator. They're telling you in real time what is truly going on in the market, sort of under the surface of the market. It's as if you're this is not a great analogy, but imagine if you're looking at a duck that's sitting on the water. You can see when it starts moving straight or starts flying or starts moving to the right. You can see when that happens. That's price action, in other words. What we're looking for is under the surface. We're looking at the actual flippers of the duck to see when it starts moving. We know the price is going to take off one way or the other. That's kind of a silly analogy, but that's kind of what we're looking at with the tool that we've created. So it's telling you which side, again, buyers or sellers, is more aggressive, and that's really why the market moves, is when one side's more aggressive than the other. Again, I could talk for 15 minutes just on this topic, and we have other videos on the site that talk about this. But what we're trying to find out is which side is more aggressive at any moment in time, and then finally the degree to which side buyers or sellers are more aggressive. Are they moderately more aggressive, strongly more aggressive, or extremely more aggressive? And that's where these level 1 and level 2 and level 3 buying and selling aggression bars come in. And these really act as a real-time roadmap to the likely short-term direction of the market. They're telling you what's going on now. They're not telling you what's happened in the past. They're telling you what's going on right now at the heart of the auction process in real time, which the naked eye couldn't see if you just looked at the time of sales. Okay, so for an example, this example is from crude oil, but again, this works on any market, any time frame. You can see on this particular day, we had some level 3 or extreme selling aggression. We always ask ourselves, can we get follow through below, and can the high hold? Okay, can the high hold? Can we get follow through below? So we have some level 3 selling bars with follow through. Here's some level 2 bars. Then we finally, so in other words, this is showing us sellers are absolutely in control of this market. You would not want to be on the long side, and being on the short side would make more sense. Okay, then you can see finally we get a level 2 bar that its high does not hold, and even before its high didn't hold, we started to get some level 3 or extreme buying aggression that came into the market. Okay, so in other words, sellers were in control here. You can see buyers in real time stepping in here. Sellers attempt to push back. They're quickly rejected by buyers. Okay, sellers have a little bit of a move back. Buyers come back in pretty hard. Okay, so you can just see pretty clearly, just from one little example, talking about it for 10 seconds, there's a lot more that you'll get to the point where you can look across the room and you can tell what's going on in the market. But I just want to give a little bit of a really quick overview that you can see, I think pretty quickly, sellers are pretty well in control here. Buyers take over here. We go a little bit two-sided here. Buyers take back over here. Okay, so that's the concept. That's the first building block. And again, we can talk a lot more in depth about that. But I just want to give a really brief overview of. And I talked about you want to determine which side you don't want to be on. You want to determine which side you do want to be on, and how do you do it? It's with these relative aggression bars. We find this to be extremely accurate, extremely user-friendly to make sense of. So again, just a real quick recap along the way here. The first step, mental state. Make sure that you're in a good state. And then the second and third step, you want to use those relative aggression bars as well as some other tools that we have to determine which side's in control, so you can determine which side you do want to be on, which side you don't want to be on. Okay? So the next step is determining a high edge or a high probability trade entry after you've determined that you're in a good state of mind and you've determined that you want to be, long or short. Okay? Now, the fourth step here then is determining the quality of the trade opportunity. And this is something that we talk about a lot, but context is so important. So many traders make the mistake of being robotic about their trading or being completely black and white and looking at every trade setup exactly the same. And that, I'm not going to say no one can make that work, but I haven't seen many people that can make it work robotically. What does work and works consistently and works for many, many people is when you can learn to put the market in context. Okay? Not every trade opportunity is equal. So if you can determine which opportunities are more high quality versus the others, you have a very strong edge. Obviously, that leads to the question of how do you determine the quality or the context of the opportunity. And the way that we do it is we have a lot of different pieces of evidence. We kind of think of them as puzzle pieces. And the more puzzle pieces that come together, or, if you were doing a puzzle on your kitchen table, for example, and, you had one piece, the picture's not that clear. You put 10 pieces together, the picture starts to become more clear. And that's the same idea here. We talked a little bit about these relative aggression bars in real time. That's kind of the heart of it, but we also have tools called high velocity moves that are in real time, support resistance zones. We have a filter. We have what we call deceleration and divergence, which is the kind of the opposite of aggression. It's when the market's slowing down in real time. And we also look at the bigger picture bias and some bigger picture key levels of support and resistance as well. So you put all these puzzle pieces together, the more of them that come together, the more of them that form what we call confluence, the better edge you have, the better opportunity you have, the clearer your vision of the market is. Okay, so to give a little bit of an example, this is an example from the E-mini S&P, but again, this works on any market, any time frame. What you see, just to give and again, we have a long video on breaking down exactly what each of these pieces is just on the website. But down here's our filter. It goes from more bearish to bullish to strongly bullish. heading into this day bigger picture, our bias was up. So all things equal, we would rather be on the long side. We wanted to monitor how bigger picture, how the market did at 53, how it did at 59. So that's kind of our bigger picture, a directional. Then you've got these, here's a level 2 buying bar, here's a level 3 buying bar, extreme. Here's a little bit of strong selling that's coming in and pushed the market down. Extreme buying, extreme buying, extreme buying, a little bit of strong selling. Okay, so those are some what we call aggression bars. Then we've got these zones here, this support zone in green, resistance zones in red. We've also got these deceleration bars, which are telling us in real time nice little turning points in the market where the market's actually slowing down. And again, I can talk about that in depth, and we have other videos. I just want to show you there's different pieces of the puzzle to help you determine the quality of when things come together. So for example, if you look at this situation right here, let's just look at this area here, or even this area here. Okay, what do we have coming together at this spot here? Well, our bigger picture bias is up. We're above this bigger picture level of 63. We've got a support zone right there as well, real-time support zone. Our filter is green. The market even decelerates right here. There's like 5 or 6 pieces coming together all at once, not to mention we've got really strong buying from earlier, low of a extreme bar right there. There's a lot of pieces of evidence coming together showing us, well, this is a pretty high-quality opportunity right here. Here's another really high-quality opportunity. Here's another high-quality opportunity. Or you can just buy the breakouts. There's a lot of different ways you can do this. The idea is that you've got some context, bigger picture, and in real time to help you see what's going on. Okay? So once you've done that, once you've determined what the quality of the opportunity is, then you want to think about the other side of the coin, the acceptable level of risk relative to that opportunity. Okay? And again, not all trades are created equal. You can't be black and white or robotic about trading. And one other thing that so many people make a mistake about is they think about successful trading as being right or wrong. Did that trade work? Did that trade not work? Did the market go up when I thought it was? Did it go down when I thought it was? That's not, that obviously is important, but that's not the key to trading. The key is your ability to manage and balance your risk versus the level of opportunity available in the market. Okay? If you can get this balance point right, you can take higher risk, lower opportunity trades as long as you keep your risk low. You can put on more risk if you have higher opportunity. It's really about balancing those two ideas, and you have to be able to see the market more clearly to be able to do that. But if you can keep your risk and opportunity in balance, you will succeed at trading. Okay? Let me give you a basic example about talking about, choosing risk relative to opportunity. Okay? So here, I'm not going to give you any context, but we have a breakout here on a level 3 or extreme buying aggression bar. It's at the high of the day when it happens. Okay? So what are your options when that happens? Well, if this is a trade opportunity that's more aggressive, or there's a lot of opportunity in the market, you can just buy the breakout. Buy it right at the market. Okay? Your stop will be a little bit wider. Ideally, you'd want your stop to be below the low of that level 3 aggression bar. But if the opportunity is really strong, you've got some evidence there, so you can take on more risk. Okay? Now, if the context of the market's telling you that this is not as good of an opportunity and it's a little bit more risky, well, then you may want to wait for a pullback toward the low of that bar. Okay? You still have a pretty good opportunity there, but you've really reduced your risk. So again, if you can put this in context, rather than just looking at every breakout on the high of the day as being equal, what happened earlier? What is the bigger picture context? This is all stuff that we talk about so that you can decide, do I want to put on more risk? Do I want to put on less risk? Okay? That's a very brief and generic example, but I just want to talk about the choices that you have based on the context of the market so that you can determine how much risk or how you want to manage that trade relative to risk versus the quality of the opportunity. Okay, so again, just a little recap along the way, and we're almost done here. Our mental state needs to be in good standing. We want to determine which side we don't want to be on, which side we do want to be on. We want to be able to put the market in context to determine the quality of the opportunity. Then we want to take an acceptable level of risk relative to that opportunity. Okay, the next step along the way, and we're almost there, is managing the trade or exit strategy. Okay, so what often happens with a lot of traders that we speak with is that sometimes they get out of nice trades too soon. They might be in and it just putters around and they get out for a 2-tick profit and then it runs 10 points. Okay, or perhaps that you manage you get out of trades because you're scared that you're going to take a bigger loss, or you're afraid that you're going to give some of your profit back. Other times, or other people tend to hold trades too long, going for the home run trade that doesn't materialize. So the key and the goal of trade management or exit strategy is, ideally, you want to be able to minimize loss on losing trades. You will have losing trades, but if you can minimize the loss that you take, the dollar loss on your losing trades, and if you can maximize the gain on your winning trades, again, there's really not much more that helps your P&L than being able to do that. The key is you don't want to make exit decisions based on your emotion or based on, gut feeling. That typically doesn't work in the long run. What you want to do is you want to be able to exit when the evidence tells you to do so. Not sooner, not later. When the evidence tells you to do so is the key to exit strategy. So again, this is the example I showed about 2 slides ago, that breakout on the high of the day. Now, what if I told you beforehand that this market was in a serious bull market bigger picture? Earlier in the day, we'd had a lot of bullish evidence that had come in. So that we were looking at the 62 level as potential bigger picture resistance. So we're breaking out on all of those factors. Well, that's telling you there's a lot of opportunity, and in this case, it would have made sense to get in toward the high of that bar on just the breakout trade. Okay. So with that said, we're talking about exit here. The key here is you're long. You have good opportunity. So what is your mindset at this point? You want to be able to hold this trade absolutely as long as possible. If this thing runs for 10 points, 20 points, you want to take advantage of it. If there's nothing there, then the evidence will tell you that, but you want to give it as much opportunity as possible. So in this case, we buy in here. We have more buying. There's no selling that's come in of any import. More buying. And this would be hard for a lot of traders. This is a good half an hour of real time where this market doesn't do much. But you can still have confidence to sit on that because there's no evidence telling you that selling is coming in. Selling doesn't come in here until we get to around 68. That's when selling comes in. So you can simply get out once you see some follow through on some selling. Okay? That's the key. This thing could have gone for 20 points. It could have gone for 2 points. But the key is you didn't get out too soon. You didn't get out too late. You waited for the evidence to tell you when some true selling was coming into the market so that you could get rid of your long position. In other words, you got long for a reason. Let's stay long until that reason is no longer valid. Okay, I hope that makes sense because it's just such a key point. So finally, step 7. And again, just like step 1, which was your mental state going into the trade, do not discount or overlook this step as well. But step 7 is you really have to own your decision. And by own, I mean you have to accept the decision that you made. Because remember, as a trader, your job is to make the best decision you possibly can with the information you have. You're never going to be perfect, and there is no certainty in trading. You're simply trying to use probability to make the best possible decision that you have. So if what you've done is you've used the prior 6 steps, you made a perfect trade. You were in the right state of mind. You determined which side it made more sense to be on. You determined the quality of the opportunity. You determined how much risk you should take relative to that opportunity. You didn't get out too soon. You didn't get out too late. You made literally a perfect trade. Does that mean you're always going to have home run huge winners? No, it doesn't. Sometimes you're even going to lose trades. You're going to lose money on when you take perfect trades. It's still perfect because you made the right decision, the best possible decision. And no matter what the result was on that possible trade, if you can accept that and know that you followed that decision-making process, I promise you, if you can do that again and again and repeat it every single time, you will have amazing results because that is the key to trading. It's being a professional decision maker. It's putting the odds in your favor. It is simply doing the right things, knowing the profits will take care of themselves. I really hope that makes sense because that is so important, but you have to own your decisions. So for example, let's say that I didn't get on a trade because I felt like it was taking on too much risk, and let's say that it would have been a huge winner. I have to own that decision. I have to live with that because I made that assessment, and I know that if I continue making that assessment time and time again, it's going to work out. Even though I missed an opportunity on this particular trade, I can own that. I can accept that. I don't have to go chase it. Okay, and there's a lot of ways you can look at this, but that's really the key to trading. So finally, at the end of this presentation, and thanks for sticking with me for this long. This one a little bit longer than I expected it to, but again, I hope you got some good stuff out of this. Basically, if this concept or this process resonated with you, I can say with pretty high certainty that you would like this software, you would like this method, you would like the way that we teach. And I would recommend a few things at this point. There's a ton of information on our website, but perhaps the best thing you can do is if you had a direct question, just send us an email. We'll get back to you within a day, typically at the most, sometimes within a half an hour, okay? Or you can give us a call, leave a message, whatever the case may be. We'll get back to you. Ask questions. If you have a specific question or you have a specific question relative to how you trade, ask us. Also, there's a ton of information on this Learn More section of the website. There's about 5 really kind of overview videos. We talk about aggression bars in more detail. We talk about the different pieces of the software. We talk about exit strategies. A lot of different ideas there. That's a really good overview spot there. And also you can check out the videos and articles. That's kind of where we do 2 or 3 videos a night, or excuse me, a week or so on average, where we give some market examples of what's going on, or we talk about a lesson here or there, whatever the case may be. There's literally hundreds of videos and posts and things like that, live trade examples. Check it all out, but I do recommend you ask us some questions and we can just directly answer your question and get back to you as soon as possible. So again, thanks for watching this presentation. I hope you gained from it, and we would love to hear from you with any questions that you might have, and good trading. Thanks a lot.